2021 was another big year for FANGMA stocks. If you're looking at the S&P 500, it returned about 27% in 2021. But actually, a big chunk of this return came from the growth of big tech. As an example, Microsoft, Apple, and Google together accounted for about 7% of the gain, or about a quarter of that total return. At the end of the year, FANGMA actually made up around 23% of the S&P 500's index value. In 2019, that figure was closer to 18%. By the end of the year, the combined market cap of FANGMA was actually over 10 trillion US dollars. Now I'm going to spend a few minutes going over some of the highlights from 2021 of the FANGMA stocks. So first I will start with Google. Google actually led the pack from a return perspective. The stock was up almost 70% in 2021. And this was actually the company's largest annual gain since 2009. Google gets a majority of its revenue from Google's advertising business, which proved to actually be very resilient during the pandemic. Google actually represents more than 90% of internet search visits in the US. Many are expecting more growth to continue in that area of the business, as e-commerce and digital advertising will only increase as the economy continues to recover. Google Cloud also contributed to the company's overall growth with the continued shift to work from home. Google Cloud is currently the third largest cloud provider behind AWS and Microsoft, and it's actually benefited a lot from the multi-cloud trend where businesses are actually deciding to spread their workloads across a couple of the largest providers. The second company I'll touch on is Microsoft. Microsoft was up over 50% in 2021. The core driver of the company's growth has actually been their Azure cloud business. Year-over-year sales growth for Azure has been over 50% for the last several quarters, and it continues to steal market share away from AWS. Another area that Microsoft stands to benefit, and something that's being talked about a lot right now, is this anticipated growth in augmented reality and immersive experiences. The company actually won a $22 billion contract to supply more than 120,000 VR headsets to the US Army in 2021. Apple had another impressive year, up 35% in 2021, and reported impressive earnings growth throughout the year. The company was, however, impacted by the ongoing semiconductor shortage, but was able to fare much better than other players just given their size and their scale. In addition, the switch to remote work actually benefited Apple as it led to a surge in demand for computing products like their Macs and their iPads so people could switch to work from home. Looking forward over the next few years, something to watch will be new product launches, which could include AR and VR headsets or even a self-driving car. Amazon is also a great company to talk about because the company offers an opportunity to invest in three of the most important elements of the current economy. The first one being online commerce, the second one being cloud computing, and the third one being transportation and logistics. Amazon did have a tough 2021. The stock was only up about 3% for the year. This is largely because of the slowing growth in e-commerce as a lot of shoppers returned to physical stores as economies started to open up around the world. Amazon also suffered from increased regulatory scrutiny and some product shortages as well. Having said that, Amazon could be poised for strong growth in 2022 based on their e-commerce outlook and cloud computing business. Looking at e-commerce, currently only about 20% of retail sales are online, and that figure is actually expected to accelerate along with Amazon's market share in 2022 and 2023. And then finally, looking at AWS, so their cloud business, AWS had a very strong 2021 and actually finished 3 straight quarters with impressive revenue growth. So finally, Netflix is the smallest holding of the group, but was still up over 10% in 2021. Netflix subscriber growth has grown substantially in the pandemic as people are looking for ways to stay entertained in lockdowns. Squid Game, which was released this year, was actually the company's biggest TV show ever, with 142 million households globally that watched the show in only the first 4 weeks. The company also announced their move into gaming by acquiring Night School Studios after their CEO actually went on record saying that they are more scared of Fortnite and YouTube than they are Disney Plus and Amazon Prime competing for consumer attention. Despite overall very positive returns in 2021, as I just mentioned, technology stocks have been under pressure recently on rising inflation concerns and rate hike expectations from the Fed. As a result, investors have actually started to rotate out of a lot of high growth technology names with very high valuations. Big tech has been sold off recently, despite their 2021 earnings, just in this risk-off market environment. One thing we want to remind investors is that FANGMA stocks have continuously provided some of the most consistent earnings in the entire market. In fact, Microsoft is the only FANGMA stock that is currently trading at a PE ratio higher than it was at the end of 2020. We do expect FANGMA to continue to drive market return in 2022, as investors will continue to pay for consistency in earnings growth.